What we're seeing here is a fascinating symptom of what is not being discussed openly. This is not tariffs. This is not price arbitrage between New York and London. This is a world turning away from the US Treasury as a tier one asset, turning away from the US dollar as a safe asset, and preferring that boring analog pet rock physical gold as a strategic asset, as the BIS has warned, as the BRICS have shown, as frankly even the Trump administration and Scott Bessent recognize. Scott Bessent's a very big gold investor. You can't say the quiet part out loud. You can't have the New York Times, the Wall Street Journal. I'm not a conspiracy quack, but you can't say the world wants its gold.
China, Russia, and other nations are exiting their dollar-denominated holdings in favor of gold. This action should put pressure on the dollar and US Treasuries. MatthewPiepenburg is a hedge fund manager, financial analyst, and partner at Matterhorn Asset Management. According to him, gold's rise is not just market fluctuation. It signals waning confidence in US Treasuries and the dollar. Concurrently, Piepenburg noticed that since 2022, central banks have doubled gold purchases while cutting US Treasury holdings. This, he argues, shows a clear preference for tangible assets over paper promises. The decline in foreign official dollar reserves beginning in September aligns precisely with the reversal in 10-year yields. Since the September FOMC meeting, foreign official institutions have reduced their dollar reserves by $113 billion. At the same time, nominal and real 10-year yields rose by 70 and 100 basis points, respectively. While observing the market, Piepenburg states a fundamental shift as global investors prioritize physical gold over paper contracts. Looking at the market fundamentals, Piepenburg highlights that mainstream media downplays gold's surge as it challenges the financial system. Piepenburg reveals that COMEX faces record physical gold deliveries, sparking questions about its true supply. On February 3, 2025, President Trump signed an executive order to create a sovereign wealth fund within 1 year. Standing next to him when he signed the order was Treasury Secretary Scott Bessent, who told reporters, "We're going to monetize the asset side of the U.S. balance sheet for the American people." On February 7th, the Financial Times speculated that it refers to gold. According to the Wall Street Journal, banks are using security firms to move gold in armored vans to London's airports. JP Morgan alone plans to deliver $4 billion of gold to New York this month. This gold rush has triggered a logistical nightmare, with some clients waiting up to a week to retrieve their gold from the Bank of England's vaults. Now, we present the clips of MatthewPiepenburg's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Countries, counterparties, trading desks, you name it, want actual physical gold, which is completely new to the churn and burn, keep it spinning and rolled over COMEX market of old. And so what we're seeing here is a fascinating symptom of what is not being discussed openly. This is not tariffs. This is not price arbitrage between New York and London. This is a world turning away from the US Treasury as a tier one asset, turning away from the US dollar as a safe asset, and preferring that boring analog pet rock physical gold as a strategic asset, as the BIS has warned, as the BRICS have shown, as frankly even the Trump administration and Scott Bessent recognize. Scott Bessent's a very big gold investor. But you can't say the quiet part out loud. You can't have the New York Times, the Wall Street Journal. I'm not a conspiracy quack, but you can't say the world wants its gold. COMEX is being drained because no one trusts Uncle Sam's IOU. Physical delivery is going out the door for a reason. You can't say that because what that means is the gold price is rising, as we're seeing, all-time highs in all currencies at the same time this is going on. This is not a coincidence. If the gold price rises, this is a thing that terrified Kissinger and Nixon and Volcker years ago. If the gold price rises out of control of the COMEX and the permanent boot to the neck under the futures market, that means the US dollar, the mighty dollar, and the US 10-year Treasury, the IOU, simply isn't what it used to be. Doesn't mean the end of the dollar, doesn't mean the end of the world reserve currency, doesn't mean the end of the 10-year IOU. It just means that we're no longer talking about when things are breaking down. They are breaking down. And so what we're seeing in the COMEX market is absolutely fascinating. It's record levels of physical delivery coming in and physical delivery going out. In terms of the gold price, there are two ways to look at this. You could say, well, okay, I hear you, Matt, but they needed physical gold to continue this post-Basel III short. They needed more physical gold to play this paper contract game. Now they've got it. Can't they now continue to exercise the ratio of 4% gold, 96% paper, and keep shorting gold or silver. What I'm saying is that depends on if the gold that's coming in, the 400 metric tons and counting, either stays put or is a revolving door to keep going out so that the COMEX can meet its delivery demands. So the question will be, is the gold stockpile on the COMEX warehouses a movable feast, revolving door going right back out, or is it being restockpiled to continue the short? And that's to be determined, but gold's reaching all-time highs. My view is, and what we have to be careful and what we need to watch is what we're really seeing, fascinatingly, is the world wants physical delivery. The COMEX didn't have enough. It's going right back out. And what that means, again, not the end of the world, not the end of the dollar, not gold going to 20,000 tomorrow, but we're getting fairer and fairer price discovery. The COMEX is running out of its traditional tricks. It's trying to reload its gold. How long it can hold it there is to be determined. But regardless of predicting that, what we do know is what we've been arguing for years and for months and now for weeks and days. This was going to break. I've been writing about the COMEX for 3 years. I said, just keep waiting until they need more physical gold because they run out because there's more demand for delivery, more open interest, which is ratcheting up to the moon. That is a sign that the world is no longer just kind of curious about worrying about the US Treasury or worrying about the US debt levels or worried about Uncle Sam's IOUs. No, they're generally, absolutely, openly and obviously worried now. Again, that's what we're seeing. And that's the real truth. Trust in the dollar, trust in the 10-year, trust in the US sobriety, mental health, physical monetary health is now clearly at its all-time lowest in years. And that's why we're seeing this move. It's absolutely tied to the debt, to the treasury market, to the currency market, to the precious metals market, to our monetary policy. It's all tied together. And the COMEX is just the latest symptom. When you combine the COMEX outflows and inflows with the treasury auctions that since 2022 or 2000, really since 2014 have been net buyers of gold and net sellers of treasury, that's a symptom that they don't trust the dollar and the treasury. And if you look at since we weaponized the US Treasury under the Putin sanctions, whether you like them or not, whether you agree with them or not, the annual central bank purchase of physical gold has doubled since 2022. These are all connected. The distrust of the US IOU, the preference for a tier one asset and physical analog pet rock gold form is higher than that paper IOU from Uncle Sam. It's really that simple. It's dramatic. It's not the end of the world.
In the United States, the Congressional Budget Office forecasts that the debt-to-GDP ratio will exceed 150% by 2034, up from 98% at present. Put another way, that will slingshot the nation's debt to the highest levels in U.S. history. To quote analysts at GSC Commodity Intelligence, the next 10 years will be known as the decade of debt. Rising U.S. government debt has often coincided with strong gold performance, as seen in the mid-1970s and early 2000s, and from 2019 onward when borrowing surged. MatthewPiepenburg's analysis underscores that the debt crisis is no longer theoretical. It's now an undeniable reality. As trust in fiat money erodes, gold is entering a secular bull market, not due to any change in its nature, but because paper currencies are weakening. With no viable path out of the debt spiral except inflation, gold's rise is both inevitable and necessary, despite potential short-term fluctuations. Gold remains near its record highs, extending its multi-week rally as investors seek protection against economic uncertainty. Persistent inflation, U.S. trade policy concerns, and shifting Federal Reserve expectations continue to drive gold's appeal as a safe haven asset. Let's get back to the interview.
Like I was listening to Alistair McLeod talking to Dunnigan the other day, and we were talking about this notion of can kicking, us gold buns, we talk about how the debt's been kicking the can. As Alistair rightly said, we're not even talking about the can kicking anymore. The can has been kicked. Now we're hitting that point where the debt really is now mattering. So the gold price direction is now going to accelerate. Even von Mises warned about this, but that was in the 1950s. We're 2024, 2025 now. Now the debt problem is no longer academic, even though I never thought it was. This was just a matter of time and how long we could go. What we're seeing is it's no longer debatable. Now we've hit that wall. That does not mean that gold only goes in a straight line. But what we are seeing now, undeniably, in the last couple of years and really gaining momentum in the last year and a half and certainly the last few weeks, is that, again, the gold market is going to go into a secular bull market, not because gold's properties have changed or gold has gotten shinier or more interesting or more aware. And frankly, the West still doesn't understand gold. The gold market is rising because the fiat money world, the US credit system, the global credit system, which is money to them, which is just credit, is in a clear bear market. And the most simple way to say that and show that is you have to remember, it's a fiat bear market. A 400 ounce bar of gold, when we had 1971, before we went up the gold standard, I think it was 17,000. A 400 ounce bar of gold today is 1.14 million. Again, gold has not gotten stronger since 1971. The US dollar has gotten weaker. That's why the gold price is rising. The dollar is getting weaker because it's been monetized to an extreme and criminal degree to cover US debt levels, which are beyond the pale of rational, the highest debt levels in the history of the world, and certainly in the history of America. If debt destroys currencies and debt destroys empires, we are at that turning point. Again, not the end of the world, but a very different world. Not the end of the world reserve currency, but a very different currency, respect-wise, use-wise, tier-wise, strategically reserved-wise. The de-dollarization of the BRICS is not a joke. The de-dollarization of the COMEX is not a joke. The move towards gold is not a gold bug argument. It's history in motion. And the price of a gold bar, a 400 ounce bar from 17,000 to over $1 million, is not a gold bug argument. It is a symptom of fiat money in general, and the US dollar in particular dying. So people need to get past people talking their book or gold guys talking up gold. But of course, gold is going to go higher because there is no way out of this debt crisis. There are three options, Elijah. There are three options with gold. Or the U.S. debt crisis. We can default, which I don't think is a real option because we have a money printer. We can add a zero at any central bank and solve the default problem. We can try to produce our way out of this debt crisis through GDP, but as von Mises or David Hume or Ernest Hemingway or any good professor in any business school will tell you, when your debt to GDP crosses 100% and gets into the 125%, mathematically your growth stalls by 1/3. So we can't grow our way out. So the only other option, the third option, is to inflate our way out. We're debasing the currency. As we debase the currency, gold goes up. As gold goes up, nations and counterparties on the COMEX want their gold out of the warehouses, and nations around the world want to buy twice as much gold as they did pre-2022. They're buying twice as much now because they trust gold more. It's that simple. Does that mean that gold will only go in a straight line? No, because if we do eventually see mean reversion in the market, I'll say this, if the markets go down 50, 60, 70%, as they should at some point, unless we nationalize them, literally, we could do that. But in a moment of mean reversion or even a recession, anything that's not nailed down is going to be necessary to cover margins. And so gold could retrace. We can't be certain of that, but even as a gold executive, I can't just say gold only goes up and to the right. So of course, but the trajectory, secular, 3,000, 3,500, 4,000 is just the beginning. And that shouldn't be to get your juices flowing for speculation. You should buy gold for 20, 30 years out for the long term, because there's no miracle for paper money anymore. We're seeing extreme examples of that right now at the Treasury auctions, at the COMEX, among the BRICS nations, all of which have their own problems, by the way. It's not as if the BRICS are totally healthy and America's the only one ill. It's not as if the things that Trump is trying to do to cut spending are totally naive. What I'm saying is it's far too little, far too late. And so to your question, yes, gold will continue to go higher, not in a straight line. Of course, if we have a real crisis in the markets and the markets are got plenty of needles pointed at their red balloon, you could see a small retracement in gold and then really raking high to all-time highs.
According to analysts at GSC Commodity Intelligence, the precious metal is being driven by a multitude of bullish tailwinds, including the ongoing de-dollarization movement taking shape globally. Central banks around the world are continuing to accumulate gold at a record-setting pace. As global investors increasingly abandon paper assets for tangible stores of value, how will this impact financial markets, monetary policy, and the global balance of power in the years ahead? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.